Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about time in the market, not timing the market, because you always hear that dead horse quite a bit. And yeah, so we're going to do that and give you my perspective on how to look at what is going on in the current environment and talk about a little bit of what's going on in the news. So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. And so we'll obviously give you guys an update on the portfolio here. So portfolio this week, closing out at $13,853.06. We love to see it. We love to see it coming back a little bit, but who knows where it'll go based on what's going on in the environment here. So currently today we're up $146.73, up 1.07%. For the 1 week, up $363.71, up 2.7%. For the 1 month, down $410.88, down 2.88%. For the 3 months, down $516.83, down 3.6%. For the 1 year, down $553.35, down 3.84%. And for the all, we're up $603.12, up 4.55%. We got $42.99 in the cash account with $100 going in so that we can make a purchase this Friday. So that is the portfolio as it stands. But let's talk about the old adage of time in the market, not timing the market, because I feel like a lot of people are trying to time the market, or they have a little bit of fear in investing right now because they don't know what's going to happen, quote unquote. Remember that, quote unquote. They don't know what is going to happen. And I think that this could be an opportune time where people will be missing out, or they might just not have the capital to do it. And I'm not going to pretend to be an economist or anything. I'm just going to give you my perspective on that old adage of time in the market, not timing the market. And so let's go all the way back, and I'm going to use a general investment strategy, which is in indexing. And we're going to use the S&P 500, as probably most people know about it. And we're going to go all the way back to World War II. In fact, during World War II. And if you were in right now, if you could travel back in time and go all the way back to that point, and you could tell your great grandparents or your parents, or your grandparents to start investing so that they could build that legacy, that general wealth that could be passed down, would you tell them to invest? Because during that time, the market was not that great either. And no one knew what was going to happen. There was this big controversy that was happening. And please don't forget about Remembrance Day, which is happening in November, of course, for us. And then, yeah, so just going back to that time, there's a time in that market where the market went down. And I guarantee that a lot of people were afraid to invest in the marketplace at that time because they didn't know what was going to happen. It kind of sounds familiar, like right now, no one knows what's going to happen exactly, and no one can tell what's going to happen. But through that time, of course, the investment in the S&P 500 would have gone up, and so let's move forward to 1970, where maybe your parents or even grandparents at this time were having the oil embargo happen. Okay, another time where the market absolutely crashed, dipped. Would you tell them to keep on investing during that time? Because no one knew what was going to happen, but it happened. That's 30 years. 30 years later. And would you tell them to happen to invest in that time? Probably, because from where it was in the 1970 to now, they would have made a great return. And let's go to step number 3, not step number 3, but fast forward to Black Monday, which happened in October of 1987. Would you tell your parents, or would you have wished, because I'm sure there's people that were born in 1987 that are not in retirement age, but would you have invested or told your parents or your grandparents to invest during that time? Because the market dipped, and guess where it is today? Where it's at today, the S&P 500 is much higher than what it was on that day. Okay. Now, from 87, let's go to 2000. Year 2000, .com crash. Everyone knew about it. Everyone knew about that because it was part of the thing. But let's go to that one. Would you tell your parents or your grandparents to invest? And you're starting to see that I'm beating a dead horse with this, because you would never be able to time those periods perfectly. You would never be able to tell if you were living in that time, other than knowing the information that you know today, that the market would go up, and a lot of people wouldn't believe you. And then 2008, biggest one that probably a lot of us have lived through, whether you were a young whippersnapper, a senior, a retired senior, or a working person during that time. 2008, 2009 financial crisis. Oof. Would you have told everyone to keep on investing? Or was that the time where you thought the world was going to end? For those that were working at that time, I wasn't, but would you tell whoever, your parents, your grandparents, whoever, to keep on investing? Even though the market dropped, I think 28% that day, would you have told them? Because it's much higher than it is. It's much higher today than it was back in 2008. Or how about this? Would you have told yourself, if you could travel back to 2020, during that crash, which was just recently, to keep on investing? Because the market dropped a lot. I remember when the market dropped, I was honestly, I was shook, because it was my first actual kind of, other than kind of 2018, which kind of was a mini. It was tiny, but we made it back in 2019. But 2020 was also a year where the market, did its thing. And so what I guess I'm getting at is for those that feel like they can time the bottom right now. You can't. We could have had the bottom recently already, or it might still be coming. We don't know. But here's the thing about continuing to invest in regular intervals and continuing with the system that you have in place, the levers that you've put in place to pull during these times. And so let's go to 2008 and let's use that as an example. If someone were to invest, let's just call him John. If John were to invest during the 2008 crisis when it first happened, and just left it, and just kept on investing, his investment from that point, so from 2008 to 5 years later, he would have been up 61%. That was the number I got. And the market actually didn't bottom out till 2009. And so for those that try to time the market, we don't know when it's going to happen. It could be a year from now. It could be 2 years from now. And so my point is, don't try to time the market. Just continue with what you're doing. And if you got to dial back a little bit, dial back the amount, but don't completely stop the effects of compound interest or the compounding effect of value. And a lot of people, this is their first time experiencing something so volatile in the market. We don't know what's going to happen. I mean, I dare say it, but inflation, as always, right? And we'll talk about that as well. But just remember, it's not about timing the market. It's about time in the market. And seriously, here is a perfect example of that, because I just gave you 6 times where, no one knew what was going to happen. But if you continue to invest, what you would have today is much significantly more than what you would have had during that time, even with the fear and so on and so forth. So you can relate all those times with now and see that we are experiencing probably the same feelings that they felt back during World War II, back during the 1970s with inflation and the oil embargo, back to 1987 on Black Monday, the dot-com crash in the 2000s, and then 2008, 2009, the financial crisis. Everyone felt the exact same way, I'd imagine. And it's just bound to happen. Now, this this part of the market environment is much more intense. Okay, so now let's talk about what's happening with rate increases. So recently in the US, let's talk about the US first. The job report came out, and jobs are they're still adding jobs. Employment is going up and unemployment is going down, which actually gives the Fed, Jerome Powell, the chairman, doesn't give them very much breathing room. It actually encourages them to continue to increase interest rate hikes, which sounds very weird, but not really. I'm not an economist, but it makes sense in a way where people are still making money. People will still be spending money, which is a factor in inflation. And the same thing is happening actually in Canada. So it doesn't give, the Bank of Canada or the Fed down the US any reason to slow down rate hikes. It doesn't give them very much breathing room because there's still people making money and still spending. And it's funny because we're trying to slow down economic growth to slow down inflation. But if people keep spending and people keep doing, their normal day activities, it may seem like things are slowing down, but things are still the same. We just keep taking in what we hear on the news, which internally, I'm sure we all feel the same way, but externally, everyone's still doing their normal activities that they did, previous to 2019 or during 2020 or during 2021. In fact, it's probably ramping up. And so it's very interesting that what needs to happen is that unemployment needs to go up, employment needs to go down to slow this stuff down. Interest rates need to go up. People need to stop spending money, and people's market sentiment has to go down into the dumps and just give up in order for us to, not us, but in order for the economy to do what it needs to do, that Bank of Canada or the Fed want it to do. And so we're just in this weird, interesting place because I'm sure people don't want that to happen. They just want to keep on living their life. We're not collectively getting together and be like, we need to slow down. Although that may be like what it seems like needs to happen, but you get the point. Is we ourselves have actually caused it ourselves with the spending, with trying to get jobs. And of course, I have nothing against that. Of course, we need to support our families. We need to bring in an income so that we can, just live. And with inflation comes salary increases, which also creates, more money, in a sense, arbitragely, or whatever that word is. And people will continue to spend. Credit card debt has increased quite a bit. But eventually we're gonna see this soft landing that everyone keeps talking about. But it's not actually gonna be soft, as we know. It's gonna be a rough landing, and it's gonna hurt a lot of people. And so let this be kind of a signal. And I've hinted at this. I've probably mentioned this in quite a few videos. Start putting money away where it's an actual emergency fund, and you should have anywhere from 3 to 6 months at least, because it's bound to happen, and you want to be prepared for it. And if you have the cash flow, the surplus to continue investing, please do, for yourself. And that's not financial advice. You just don't want to miss out on what is happening. Just recognizing what is going on, and using that as a thermometer or thermostat to measure what happened in the past to now, to kind of correlate it and make your moves based on that. Because most investing is done not mathematically. It's emotion. A lot of it has emotion involved for a lot of people who invest. But if you have a system in place, your results always fall back down to the systems that you have in place. And if you have no systems in place, I don't know where that's going to get you. So other than that, guys, hopefully you did enjoy the video. That's pretty much all I want to talk about. I know it's a bit of one of those hybrid rants, but just giving you my perspective, and hopefully that the message comes across. And so again, don't forget to leave a like and subscribe, and we'll definitely see you guys in the next one. Bye.